Listen, we only get one shot at this.
Why not live life on our own terms? Hey everyone, it's Tom Kradza, and on this episode of the Your Life, Your Term show, we brought on Lyn Alden, and I can't believe we had the opportunity to chat with her. If you're not familiar with Lyn, her Twitter, her little Twitter, I can't speak, her little Twitter bio, her bio on Twitter, how do you say this? What she has written about herself on her profile on Twitter says, founder of Lyn Alden Investment Strategy, fundamental investing with a global macro overlay, finance, engineering, blended background. And what that means to me is she is one of the clearest thinkers on macroeconomics that we have ever come across. We started subscribing to her newsletter some time ago, started following her on Twitter, started watching some of her interviews, and she just has a really fantastic ability to break down what's happening right now this year and what may be happening in the 2020s using data, using historical comparisons to just give us a context of all this stuff. So on this episode of the podcast, we talk about why the 1940s is an interesting era to look at for some analysis on what may happen in the 2020s. We talk about some other macroeconomic analysts and their views and her opinions on them. We talk about populism, the destruction of the middle class. We, of course, get into things like gold, and then Bitcoin is a big discussion towards the end, and not really just, rah-rahing Bitcoin. It's how could the government shut it down? What are the threats? And I kind of pose three different things at her to get her opinions on Bitcoin. So just really thrilled to be able to share this podcast with you. She is an absolute fantastic thinker on macroeconomics. Just thrilled that we were able to have her here. Can you tell I'm excited that we had her on this podcast? Totally am. So before we get started, if you are listening to this and you are trying to make sense of the absolute crazy real estate market that is the Greater Toronto Area and Golden Horseshoe right now, with different pockets of activity acting completely differently. So for example, on the outskirts, we are seeing properties get 30 offers, 32 offers, 35 offers. It's absolutely insane. And what by outskirts, I mean like an hour outside of the city. So let's call it like, Kitchener, Cambridge, Waterloo, Hamilton, Peterborough, Barrie, all the way further to St. Catharines, Brantford, Ontario. All these areas are absolutely exploding with offers on properties. And it's what happens when the Bank of Canada chooses to reduce interest rates 1.5%. If you want some of our thinking and how we are using today's world to buy investment real estate, the strategies we're using, you can come to our free introductory training class, and you can register for that directly at CanadianRealEstateTraining.com. That's www.CanadianRealEstateTraining.com. That's an introductory class that we are doing virtually once a month right now. We share a lot of the different strategies we're working with investors right here, right now in the Greater Toronto and Golden Horseshoe area. And at the end, Nick and I stick around for a wide open Q&A on all and any subjects related to real estate investment properties, our history with it, our thoughts on the economy going forward, whatever comes to mind. So if you are thinking about getting into real estate investing and don't know where to start, you can come and check out our free 90-minute class. You can register directly for that at www.CanadianRealEstateTraining.com. That's it for now. Enjoy the show.
Are you ready to live life on your terms? Is it time to take charge? Real estate, business building, the economy, health and nutrition, and more. It's the Your Life, Your Term show with Tom and Nick Kradza. Are you ready? Let's go.
Okay, great. We are live with Lyn Alden, and I was just telling Lyn, I don't think I've prepared as much for anyone else other than Lyn. I've written down the odd question here and there. Most of the time we just hit record and start these things. But for Lyn, I feel like I needed to get busy. So I just wanted to jump in. A lot of the people that we work with are kind of concerned on what they're trying to anticipate over the next 10 years in the economy. In some of the research reports that you've put out, you make comparisons to the 1940s, and I love it. You kind of talk about the Great Depression and then the 40s. Can you talk just about why you compare this era that you see now to that era, just to kind of kick us off here? What is it? What are the similarities? And do you really believe that we can take some insights from that?
Yeah, absolutely. So thanks for having me. And so the comparison from the 1940s mostly looks at the long-term debt cycle. So this was a topic popularized by Ray Dalio, the founder of the world's largest hedge fund, Bridgewater. And it's a concept that I've kind of taken and done a lot of research on and published a lot of information on. And so, taking a step back for a second, we're all familiar with the short-term business cycle, which is like the boom bust, recession, growth period cycle. And so what happens is, during the bullish part of the cycle, leverage builds up in the system. And it gets more and more frothy, and eventually towards the end of the cycle, you get malinvestment, you get over leveraged, you get too much kind of enthusiasm, and then either some sort of external shock or some sort of natural internal shock happens, and you get a recession. You get like a deleveraging event. It's messy for a lot of people that were over leveraged, and so. But then what policymakers do is they come in and they cut interest rates to try to stimulate more lending and make it easier to service this debt. Then you also usually get fiscal stimulus to support unemployed people and other things like that, or sometimes to do infrastructure, whatever the case may be. And so what they do is they cut that deleveraging cycle short. And so then you start building up from there. And so if you string multiple um, short-term cycles together, you get what looks like higher and higher debt as a percentage of GDP in each cycle, because you only deleverage like half the way, and then you build up to a new high, and then you deleverage half the way, and so you get higher and higher structural leverage. At the same time, interest rates are doing the opposite thing, so they're getting lower and lower levels, and lower highs, lower lows, and then eventually you run into the zero bound. So interest rates run into zero, debt levels become extraordinarily high, and that's when you've reached the end of a long-term debt cycle. And so the last time we did that, a lot of my focus is on the United States, but most of the developed countries are kind of in a similar, kind of a time cycle, because it's pretty globalized. And so in the United States, for example, we hit the zero bound back in the early 1930s, the beginning of the Great Depression. And so that was a whole process playing out through the 30s and 40s. And similarly, so we hit the zero bound during the Great Financial Crisis, and then we hit it again here in the 2020s in response to the pandemic. And if you look at all sorts of metrics like debt to GDP, and I'm talking about total debt, so that's public debt and private debt. And I also break them apart sometimes and show the different kind of cycles playing out. Or you can look at debt to money supply. All these different things tend to show that there's this big kind of call it an 80-year cycle playing out in the background, and these are kind of structural big changes. And the difference between at the end of a long-term debt cycle and a short-term debt cycle is that usually a long-term debt cycle is so leveraged and so hard to unravel that it usually involves a pretty notable currency devaluation.
So when you see that, okay, so then what about other things like, how every time I look at the Congressional Budget Office reports, I don't think they include things like Social Security payments that are due to the American public at some point into some of their analysis, or how much they are reporting as their amount of debt to GDP. When you hear me say that, what comes to mind for you? Like, is this something that they're just keeping off the books? Does this make the whole situation in the 2020s even more convincing to us that it is the end of a debt super cycle here, because we're not even counting some things that we know they're going to have to pay out? Like, what comes to mind when I say that?
Yeah, in a way. So one thing that's funny about the CBO is that they never forecast a recession. So they have these 10-year forward models, and they assume just smooth GDP growth, no recession, and that's why they always understate what actually happens. So even though we literally, right before the pandemic, we had 10 years without a recession, which is the longest stretch in American history, and they were still like their 10-year projection was still just zero recessions, and that's just how they
didn't they make you laugh? I was just laughing because I look at those reports. I'm like, how can they even forecast this? I'm not an economist. I'm looking at this just kind of laughing.
Yeah,
okay, so you're on the same page.
Yeah, and there are countries like Australia that have managed to push multiple decades without a recession, so it's not unheard of. But for that to be a base case is just asking to understate it, and it's even for political reasons that you understate it, right? Because you can't just say we're practically insolvent in a decade. You have to say, if this plays out, if this is fine, then we can kind of thread the needle here, and that's just kind of how they calculate it. And so they refer to the actual debt, not the liabilities that are going to be debt. One interesting thing we saw is that so we all saw in here in 2020 the pandemic blew out everyone's finances. So we saw the American deficit blew out. We saw that Bank of Canada's balance sheet just go vertical. Every developed country
we were really good. We were really good. We were good.
Yeah, just
Canada.
Complete vertical. And so one thing I've been pointing out though is in the United States, we started to have a structural deficit going into this. So now most developed countries run some degree of deficits over the long term. What made the United States interesting was that normally we have a bigger deficit during a recession, obviously, because you get a decline in tax revenues and you get usually more spending. And then you start to get a narrowing of that deficit during economic expansions. And that's been pretty much clockwork. Now, what we saw, however, is it starting in around 2015, 2016. So we had from say 2009 to 2015 or so, we had a declining deficit as a percentage of GDP. But starting in 2016, we started to get an increasing deficit as a percentage of GDP, even though we were still in economic expansion. And that's because we started to have a demographic shift where the Social Security and Medicare became so top heavy due to demographics that our structural deficit just started basically gradually blowing out. And so we went into this pandemic with a 5% deficit of GDP, which is one of the largest among developed countries. And that was before the pandemic. And so we already have this structural thing. So even when we get all this stimulus done, or even when looking out to say 2022, we still have this structural impairment in place based on current taxation, current expenditures, and that's something that's kind of new for this cycle compared to previous long-term debt cycles, but it still plays into the overall reason of why a currency devaluation is eventually almost inevitable from a mathematical standpoint.
Okay, so then when you compare this era to the 1940s and you see the deficits, because I think one of the charts you've shared is that just the illustration that shows deficits really increasing. I think it's like early 1940s where they really get big for about
Yeah.
3, 4, 5 years. Is that something you're anticipating then we see here just because of the math that you're sharing? Like they're just going to have to run these deficits. So is this in our future? And then I want to get to some of the inflation deflation talk that you've written about recently.
Yeah, so I think so. So if you look at the 1930s, they started to run big deficits, and they hit the zero bound, and you had that kind of period of economic stagnation. But it wasn't until the 1940s that they ran absolutely silly deficits, like deficits that were like 30% of GDP. And of course, that was to fight World War II. I mean, that was like this external thing said you basically have to do whatever you can, and so that was kind of political cover to just throw money at it. And so the United States, wasn't all for the war. They also radically built up their domestic industrial base because that's where a lot of the spending was. And so even after the war, that still existed. So it was, and then they, when all the soldiers came home, they spent money to put 8 million of them into college and training programs. And so it was not just fighting in Europe and Japan. It was all this domestic spending, but it was all kind of the cover for it was the war. And so now we're in a situation where we have the cover of the pandemic. So multiple countries have all this cover to do deficits that they haven't seen since World War II. And so that can have certain benefits, but at the same time, if you look at what happened during the 1940s, most countries around the world basically ended a sovereign debt bubble in the sense that they inflated a large portion of their sovereign debt away. And so it's not.
So it wasn't real. So you're not saying it was real growth during that
Well,
era?
it was a bit of both. So you had real growth, but then you even had inflationary growth on top of that real growth. So if you were invested in things that benefited from real growth, like equities and things like that, you did well. But if you were invested in fixed income or cash, depending on what country you're in, you lost a big chunk of your purchasing power. So if you're in the United States, you lost about a third of your purchasing power, even though we won the war. We were on the winning side, but you still if you were a saver or a bond investor, you still lost on a real basis, even though you still, there was no nominal default. You still got your principal back. You still got your interest, but bond yields were capped well below the inflation rate, so you lost purchasing power, and that varied by different amounts around the world. So, for example, if you were in the UK, you lost more. If you were in Germany, it's far worse, obviously. So it wasn't hyperinflation, but it was taking a chunk of that debt away through a rather high period of inflation.
So do you think, you know how you discuss fiscal policy is really going to have to come into play here? Do you, I guess I'm just trying to think of the typical person listening to this, they're thinking, am I looking at inflation or deflation? And I think the way you articulate it's really nice is you say, hey, there's inflation in some areas or deflation in other areas, but I just want to read off some of what you kind of put together here, because this is fascinating to me. You're saying there's deflationary forces in high private debt, are deflationary. Slowing population growth is deflationary. Technology is deflationary. Wealth concentration into fewer hands that has been occurring over the last 10, 20, 30 years is deflationary. Commodity oversupply is deflationary. Outsourcing is deflationary, and you're referring to outsourcing of labor as a labor costs get downward pressure. So we have all these deflationary, things, and it kind of reminds me of what Jeff Booth talks about when he talks about
Yeah.
the technology aspect of it. Like we have this massive structural deflationary things that seem to be occurring, but then you published this awesome chart where you took some St. Louis Fed data and you said that the government transfer payments this time around have just kind of blown through the roof. So we have all these deflationary forces, but the government has just thrown so much money directly to the people or the population that, what do we look at here? Do you think some of this kind of will create some inflation in the CPI, or do we just have to constantly over the next few years understand that there's going to be inflationary forces at play in asset prices, perhaps, and the deflationary forces at play in labor costs and that kind of thing? Do we have to be, nimble enough to operate with both concepts in mind?
Yeah, I think so. I think that's a good way to think about it. It's kind of breaking it into different types of inflation, different areas of inflation. My base case is that looking out over a fairly long term, like call it 5 years, that we're going to see an inflationary cycle. And we've already had many types of inflation. So, for example, as you pointed out, with these big stimulus and government transfer payments, in the United States, broad money supply went up like 25% year over year. Which is nothing compared. Like you have to look back to literally the 1940s to find similar metrics. And so even people often point out that the global financial crisis, there was like central banks raising their balance sheets, but most of that didn't get actually into the broad money supply, whereas this year it did. So it just went almost one for one directly into the broad money supply. But we had a collapse in monetary velocity this year because people couldn't spend, they couldn't travel, they couldn't go to the restaurants. Many people were facing economic issues, so it was mostly a replacement for what incomes they lost and things like that. However, as we go into 2021, 22, 23, right? So we hopefully get these vaccines come out and with the virus just kind of works itself through the population, whatever the case may be. I mean, it's it'll be different than it was here in 2020 with so many lockdowns. And at the same time, we can slowly start chipping away at some of those deflationary forces just because of the way it's working out. So, for example, offshoring in some ways kind of peaked around 2008 and has been kind of flat since then. And now there's political trends to reshore some of that labor. So that's something to keep an eye on. Then, as far as commodity oversupply, we had the U.S. And Canadian kind of shale oil boom. A lot of that was unprofitable. Investors have gotten killed for like a decade there. So there's not a lot of new money coming in. Plus, you have the ESG kind of mandate to not, a lot of these institutions are not, putting money into oil and gas for, kind of social political reasons. And then, a lot of companies cut their capex this year, right? Because we had this big kind of temporary destruction of demand. And so if you look out over the next 5 years, there are a lot of commodities like copper, uranium, and then possibly oil and gas. Looking out, that's a little bit. There's still some of the supply gut there, but if you look out, maybe 5 years, you're starting to get less commodity abundance. And so when you have this kind of really loose fiscal policy combined with some degree of commodity tightness, I do think that inflation is somewhat of a risk to be aware of as we go deeper into this decade.
Okay, so I want to get your thoughts on gold and Bitcoin in a second, but you mentioned a podcast on Twitter that I ended up listening to where Felix Zuloff says something. He said something kind of interesting. That was a great podcast. He said something interesting in that podcast where he said that he anticipates, and I'm paraphrasing here, pretty much everything to possibly lose over the next few years, and that you kind of just I interpreted that as you just kind of want to be in the thing that's going to lose less, if that makes sense. If everything's going down, you want to be in the thing that loses less. But then he kind of extrapolated that thought onto whatever does survive the next few years is going to be taxed by the government incredibly. And so it was kind of this like negative thing. He's such a good guy and so well articulated in his thoughts, but I'm like, oh my God, like you basically, even if you pick the right thing, the government's just going to come and tax it. It reminds me, I don't know too much of it, but I think there were some windfall taxes on oil in the late 1970s or something like that. It kind of reminded me of that. When you heard him say that on that podcast, and for those listening who don't know him, he's like a macro economic analyst, I would say, investment advisor. What came to mind for you when you heard him say those things?
Yeah, so I thought that was an excellent podcast, which is why I shared it. And, his insights, I agree with like maybe 95% of what he said. There's always things around the margin that I might view a little bit differently. So I think that that particular statement, for example, was a little bit too cleanly stated. Like that,
Okay. Okay.
because it depends on what government you're looking at, right? So I think he's based in Switzerland. You're looking at, I mean, there's tons of different, developed countries, emerging countries, and so it depends on your jurisdiction. So what happens to me in the United States might be different from what happens to you in Canada, might be different than what happens in Germany, might be different than Japan. So, it depends on, where the listener is and what their kind of government's prospects are. So there's that to keep in mind, that there is kind of jurisdictional. And that's why, I mean, there's that whole like Plan B movement where people have like a second passport, right? So they're worried that, they want to reduce their jurisdictional concentration risk, whatever the case may be.
Yeah,
So
you're talking to someone who has three citizenships. I'm Canadian. My mother's Scottish, so I have a British citizenship. My father's Croatian, so I have a Croatian citizenship as well. So yeah, I'm one of those people. I'm ready to go. I'm ready to
yeah,
go.
there you
Wherever
go.
the
Yep. Whichever one is going to take
yeah,
less.
yeah.
And so, well, from a historical context, uh, these the ending of these long-term debt cycles tend to be pretty transformative changes, and they usually also occur. Going into that crisis, usually wealth concentration is at like a really high peak. And I've been sharing statistics that we have kind of wealth concentration levels. The United States is more concentrated than most other developed countries, but it's happening in many places. And so the United States, for example, we're as concentrated as we were roughly in the 1920s and early 30s. And usually during these kind of currency devaluations or kind of big kind of fiscal expansions, usually you get a reduction in that wealth concentration. And so in the United States, that took the form of you had a currency devaluation, so big holders of cash and bonds lost some of their value. Meanwhile, people on the working class, middle class, they benefited from the fiscal spending, so they got the industrial base blown out, they got education paid for, things like that. And at the same time, we had a really high income taxes. So that's when, I mean, United States technically got up to like 90% income tax rates on the top, in the top bracket. Now that's, a lot of people didn't pay that actual number, but it just kind of showed how high that scaled. And so I do think, going into this, kind of later in the decade, we're going to see probably policies like that, try to increase taxes on places that they see have, either not been taxed much, or that, where they think most of the wealth is. So I do think that kind of tax risk is something to be aware of.
Got it. And then in your analysis, do you put any or how much weight do you put towards just the emergence of more and more populism? A chart we share in Canada here is we took the property prices in the Greater Toronto area and mapped them out from 1969 to present day, and then took income from Statistics Canada and mapped out income growth. And I don't have it in front of you right now, but if you saw the chart, the divergence is just insane. Like property prices just continue this major acceleration and incomes are just this little acceleration. So the gap is just widening. And we're just calling it the destruction of the middle class in this country, which I'm really proud that the middle class here has been so good. I kind of grew up in that. So to see this kind of divergence where asset prices are growing like this and incomes are just slowly growing, I can kind of see this country kind of getting pulled around a little bit already as well. And what, does that affect any of your investment narrative at all? The populism that's kind of coming out?
Absolutely. I mean, I think that populism is what drives the eventual policy shifts. And so when you have this period of high wealth concentration, you start to get this, more and more populism. And it emerges both on the right and the left. I mean, there's different types of populism, right? So, there's kind of nationalistic right populism, then there's kind of like more socialist left pop. There's all sorts of different flavors of populism. And so it's more, I've kind of describe that as not just left versus right. There's like established left, established right, and then there's like populist left, populist right, and of course, even in those groups, there's factions in there. So there's more extreme, there's less extreme elements. There's all sorts of. It's a melting pot, and so populism tends to rise during these periods. And there's actually a really good book called The Fourth Turning. By Neil Howe. He's a historian that covers it and shows, kind of I focus on the financial cycles, whereas he shows that kind of the social and political cycles that happen along this kind of long-term debt cycle. Because all of his kind of crisis era fourth turnings that he calls them happen during long-term debt cycles. It's kind of this big period of transformative change. And so I do think populism is a factor to be aware of in portfolio management, right? Because you have to take that into account in your jurisdictional risk, as well as when you estimate what fiscal policy is likely to look like over the next, call it 5 years. because you see, where the kind of population is headed in terms of things that they want or that they expect, or kind of that certain things are at a breaking point.
I watched Yugoslavia go through hyperinflation. We had family there when that was going on, and it kind of broke into pieces. And I kind of noticed something that it's why I got into gold really early, and why I've always kind of believed in gold, because I noticed that anyone who had a little bit of gold, anyone who had cash, basically at one point, our aunt went to the bank. They didn't even count the paper currency. They just had a little plexiglass box, and they asked you to stuff all the currency in there. And when the box was full, they give you a certain amount of denomination of the new currency. Like, as ridiculous as that sound, that happened in the 1990s. Like, that's not that long ago. And I noticed that the people who survived that were basically the poor. It didn't matter because you had no savings. You're kind of living hand to mouth a little bit. It doesn't matter when the currency kind of changes over. If you're a farmer and you have some, you can supply yourself with food, none of that really affects you too much. The middle class really got affected. There's not much middle class there, but I mean anyone who had some cash savings, they kind of just got wiped out. But the people who had ownership in things, they kind of survived, because although it was denominated once, in dinars, and then later maybe even the mortgage went to Swiss francs or something entirely different, you owned that property. And I've always thought ownership of assets is important in times like this, because you can let the currency kind of flail all over the place, but if you can control the asset, manage the income and the expenses really well, you're going to survive. It doesn't matter what comes your way. And it's kind of why we got into real estate, because we thought, oh, this is a growing population base here. Interest rates are low. That's our biggest risk. So let's watch that. But if we're smart with our properties, we might be able to survive anything that comes our way, as long as there's demand for them. The price might go way up. They might come down. I don't care. As long as the income is covering my expenses and maybe leave some left over, I think I'm going to survive whatever comes my way. And a lot of that thinking comes from that era in the 1990s and what I saw go down in Yugoslavia, because owners of assets seem to get through that no problem. When you hear me say that, what do you think? Do you think that's completely ridiculous?
No, I agree. I mean, historically, the best kind of assets to get through this cycle are harder assets. So things like, real estate, precious metals, commodity companies or commodities themselves, it's equities to some extent. So all these kind of different, harder assets. And then especially if you tie that so that your liabilities are fixed income, fixed rate, whereas your income sources are more variable. That's kind of the best kind of setup you can have to kind of get through some degree of currency devaluation. And so that even in hyperinflation, you want to own kind of harder assets. And if you have just kind of, non-hyperinflation, you just have, inflation shooting above expectation for a few years, it's still good to be in those kind of harder assets and to have your liabilities denominated in currencies with fixed rates that are kind of getting inflated away. So that's actually a structurally good thing. And there's also, that's also where you get that kind of that previous discussion of, even if you do the right thing, you have to then watch out for political risk, because even if you do the right thing, you can still, they kind of go after people to do the right thing. So for example, you mentioned, so if I point out to Argentina, for example, anyone who was holding, say, gold or dollars during some of Argentina's kind of famous currency crises, those people did well. But then if they, had their dollars in a bank, for example, they would just say, oh, sorry, your dollars are being converted to Argentine pesos. Thanks for playing. Try again next time. And so that's kind of a risk to watch out for, is that, you can do the right things, but if you have counterparty risk or jurisdictional risk, you can still kind of get kind of hit by a trap there.
Yeah. And the thought that comes to my mind is also deflation. Because if deflation comes in and you're holding debt on some properties, great, you're managing the income and the expenses, but it's not going to be a good feeling if the prices deflate down and your debt's greater than the asset price. So that's kind of always in the back of my mind. When you said equities as one thing to invest there, what do you mean when you say equities? Which equities are you talking about?
Well, like the stock market, like individual
Okay.
stocks, or so stocks have a less clear relationship with inflation. So things like real estate, precious metals, commodities, they do well in inflation. Bonds do poorly. Then generally the opposite for deflation. Stocks are a little bit in the middle for a couple reasons. One is that they're very sensitive to interest rates. So if you have low interest rates, so if you can't get almost any income from, say, a 10-year government bond, you're willing to pay up for a dividend stock, right? Because if sovereign bonds yield 5% like they did a couple decades ago, you demand pretty high dividend yields and pretty high growth from your stocks in order to compete with that safe kind of guaranteed income. However, when sovereign bonds yield so low or near zero, you're willing to pay up for these dividend stocks because you're still getting, say, a 2 or 3% dividend yield. You're getting some growth. You're getting some sort of inflation protection. Now, the problem is if you go all the way down to zero interest rates or even slightly negative interest rates, and you bid the price of equities extraordinarily high, then if interest rates ever rise, that tends to put downward pressure on those valuations. So even though your cash flows are still intact, you can be impaired by valuations. And so if you look back over the previous two inflationary decades in the United States over the past century, it's the 1940s and the 1970s. And so the commodities did fine in both decades. Like that's some of those kind of hardcore inflationary assets did great. Equities were mixed. So in the 1970s, we had inflation, but we also had the central banks rapidly raising their interest rates to try to combat inflation, and so that put downward pressure on equities across the board, especially growth-oriented equities that are more sensitive to high interest rates, whereas value stocks did they held up better. Now, if you look at the 1940s, equities did very well despite being inflationary. And that's because of a couple of reasons. One is they started that decade at low valuations because we had the Great Depression, then we had a war, so people were pessimistic. Whereas the 1970s, by the late 60s, stocks were very highly valued. So the 1970s, you had a decrease in stock valuations, a raise in interest rates, and so you had poor stock performance in the 70s. In the 40s, they did not raise interest rates despite high inflation, because sovereign debt was so high. And that's the difference between a long-term debt cycle and not being in that. So the 1970s, you had low sovereign debt as a percentage of GDP and low debt in general. So they were able to raise interest rates to combat inflation. Yeah, at the end of a long-term debt cycle, like in the 1940s, the private debt was high, but it was particularly sovereign debt was so high that they had to cap, the central bank just capped yields for the entire sovereign bond duration curve. And so you basically had the full curve below the inflation rate. And so stocks still benefited from low interest rates, even during an inflationary environment. So equities still did reasonably well. So it partially depends on what nominal interest rates do in that inflationary environment. And it also depends on the type of stocks. If you buy a highly valued tech stock, that's less likely to do well in inflation. Whereas if you buy a beaten down, like industrial company or something that has pricing power and is cheap, that tends to do pretty well in an inflationary environment.
Yeah, got it. Okay. Okay. So it's a return back to value almost, because if you can pick the right value and the stock market outpaces inflation, so you have a real return there. Basically, whatever you've invested is going up more than the currency is being devalued. You
Yeah.
can actually get a net gain in that environment,
Yes.
like a real gain.
Yeah.
Okay. So what about, all right, I just want to get your thoughts on Bitcoin and gold here a little bit, because one thing that we've always told everyone we work with is that hey, have some good income producing hard assets. And we believe income over the next 10 years is going to be gold. We're calling it like the unicorn. Like if you can create income from properties, that is the unicorn going forward, because an income stream is going to be invaluable over the next 10 years. But if you're going to have some savings, you want to have it in some hard money. So since 2008, Nick and I have been telling everyone who will listen, buy gold, and like buy gold bullion. Get the bullion, tuck it away somewhere. This is kind of like your insurance policy. Just hold some of your savings in hard money, because if they play with the currency, this is your savings. And I had outright dismissed Bitcoin for years. Like I had some friends tell me, Tom, you're gonna pay for things in Bitcoin. And I'm like, this is impossible. Like we run a business, we pay taxes in Canadian dollars. I'm not going to use your Bitcoin. And then March of this year, when COVID hits, I sit down, read some stuff. I talked to Seyfuddin Amous, read the Bitcoin Standard, and I was talking to Nick. I'm like, Nick, I think I've totally misunderstood this whole Bitcoin thing. We better get some Bitcoin, and we get some pretty quick. So we kind of dove into the Bitcoin world just this year. So I'm willing to admit I was completely wrong, and now I'm the other way, and I'm like, wow, this is a beautiful thing. And so I have some questions for you, but my first is, do you think Bitcoin may simply go up in however we measure it, American dollars, let's say, because it's the hardest form of money around? Because when I read history, it seems like people gravitate towards the hardest form of money. Like, we've you go from like agri beads and seashells to metal, like naturally humans over long periods of time. And the period of time I'm discussing maybe doesn't match someone's investment time period. So I can understand that. But if Bitcoin is what we think it may be, does it not just get more and more demand because humans gravitate towards the hardest form of money around? When I say that, what do you think?
Well, that's what's been happening to the protocol over the past decade. It's about 11 years old now or so, and so it has been, increasing its market cap pretty rapidly because, unlike every other commodity, it has a fixed supply. If you call it like a digital commodity, for example, and there's a couple of things to consider. So one is, in general, like hard assets, specifically monetary assets like gold, their biggest inverse correlation is to real interest rates. And so if you look at, say, a 50-year price history of gold, whenever, on average, it kind of goes up in price roughly at the rate of per capita broad money supply growth. So as we print more dollars, it's really this, that gold is mostly holding its value while those dollars kind of, decrease in value. And however, sometimes it overshoots or undershoots that trend based on real interest rates. And it's, if you look at a 50-year chart, it's a very clean inverse correlation, which is, say inflation's high. So say it's like, 4%, but sovereign bonds are paying you 7% because they're trying to control inflation. So you're getting a 3% real yield. The opportunity cost for holding a scarce yieldless asset that even has a storage cost is pretty high. However, when inflation is 2%, but sovereign bonds are paying you 0% or 1%, so you now have a negative real interest rate, and so it's suddenly that zero yielding scarce asset is far more attractive. And so that's this kind of long-term 50-year interplay we've had between gold and real interest rates. Now, Bitcoin is a little bit different because it's like a small cap becoming a big cap. So it's less sensitive to real interest rates because it's kind of like how a small growth stock is less sensitive to the economy than a big company that's already established. So, Bitcoin is kind of doing its own thing at the moment, whereas gold is still mostly tied to real interest rates. But I do think, going forward, Bitcoin's kind of competing with gold and it's competing with other assets because, as you point out, it's a fixed thing. It's benefiting from a network effect. So there's thousands of cryptocurrencies, but none of them have the same level of security and network effect that Bitcoin has. So it has something, it has like a very high percentage of the total cryptocurrency market cap. So every other kind of competing cryptocurrency, it's kind of like if you were to start your own Facebook, right? I mean, you could literally copy, if you copy their code and just like, here's, Tom's book,
Yeah,
right? It's just
yeah,
like,
and it would be three people on it. Yeah, yeah.
yeah, it's just like it's hard to get past that initial network effect. And so there's still like, people often look at, say, the Facebook to MySpace comparison, right? So MySpace, it started to get kind of a, kind of breakaway capacity. That was a big earlier social network, and then Facebook came and eclipsed it. However, they eclipsed it at a pretty early level. So MySpace, its last funding round is valued at something like 12 billion. So, it was getting big, but it wasn't massive yet. So it got a lead, and then a bigger thing kind of came over and took it before it kind of hit escape velocity. Whereas Bitcoin's already at over 300 billion market capitalization, it's really hard for another cryptocurrency to really kind of displace that network effect at this point. And so when you have that network effect combined with the inherent scarcity in the protocol, it is pretty attractive. And especially, when we talked about it, kind of jurisdictional risk, one thing that attracts people to gold or Bitcoin is that you can kind of it's like self-sovereignty. You can self custody it rather than rely on a counterparty. So by having, for example, physical coins, physical bars of gold and silver, for example, or platinum, you're kind of off the grid in that way. So it's harder for that to be kind of confiscated or taken. Same with Bitcoin, where it's encrypted, so you don't need a counterparty to hold it. You can have your own private keys, and you can kind of, do the transactions off the grid. Now, there's still, of course, jurisdictional risk from making it illegal. Even if they can't physically take it, they can still kind of outlaw it or tax it to death or something like that. So there's still kind of that jurisdictional risk, but it's less so than if you have money in the bank or you have kind of an ETF or something that kind of hosts that for you. There's kind of that extra layer of self-sovereignty.
And I guess because that's the biggest kind of risk that I can figure out. Because I read your recent article on Bitcoin, which was great, where you kind of demystify a lot of the things that people criticize about it. So that's just a great read. But then I was thinking, I was listening to Jim Rogers speak recently, and he said something in the 1930s how the Bank of England basically said, hey, you can't use any other currency but our own, and it's an act of treason if you use any other currency. And I thought, okay, so here's then the best negative, because I'm pro Bitcoin. Like I'm on the Bitcoin bandwagon completely at this point. But I'm like, okay, the threat then is that the government comes in and says, oops, this is getting a little bit too crazy. We're going to make it illegal. We're going to tax any profits, excessive gains from 2020 on, anything that you've owned. We're going to tax like 80% of that or whatever. It's also illegal. And we are going to release a central bank digital currency that's partially backed by gold. And I know that that would be hard for them to do, but I'm like, that's interesting, because now if they say it's partially backed by gold and the fine print of it allows them to play around with the allotment of gold to their CBDC, I'm like, that's a pretty powerful threat. When you hear me say that, what do you think? Do you think first they would make it outright illegal? Second, that, excessive taxes on any excessive gains? And then third, would they ever do a CBDC partially backed by gold?
So yeah, there's a bunch of questions there we can kind of unpack. So I do think that looking at jurisdictional risk is important for Bitcoin. And so of course there have been some countries that have banned it or pressured it, whereas it's been pretty free in most major capital markets. And so one of the concerns there is if it gets big enough, it becomes threatening enough that they might ban it. And so it is something to be aware of. So far it's been going in the other direction, where for example now banks can custody it, for example. And also, if you look at, kind of the amount of kind of institutional kind of ecosystem built around it, it's, the bigger it gets, in some ways, the harder it gets to ban, because then you're going after, say Bitcoin goes up to $1 trillion market cap, right? So it triples from here, and you have Fidelity involved in kind of institutional grade custodians. You have, Grayscale Bitcoin Trust. You have Stanley Druckenmiller investing in it. You have Paul Tudor Jones investing in it. You have two publicly traded companies on major stock exchanges. So MicroStrategy and Square have part of their corporate treasury invested in Bitcoin. Once it kind of achieves that level of adoption, especially among the donor class, right? So it's not just small retail investors now. It's the full stack, from the retail investors all the way up to the politically connected. We now have, in the U.S. we have one senator elect that is, she custodies her own Bitcoins. And then we don't know however many other politicians, have like a Coinbase account or something, but she's actually kind of a more hardcore kind of Bitcoin enthusiast. And so basically when you have that kind of momentum, that becomes quite difficult to unravel, especially if you've seen the kind of the fervor among some of the Bitcoin supporters. Like you can imagine, if you look at Chile, for example, back in 2018, they had massive protests over the fact that they raised their like subway fares by like the equivalent of a nickel, because it was the straw that broke the camel's back, right? So it was kind of, it wasn't really about the nickel, it was about kind of this whole as they saw it, this wealth concentration, all sorts of macro factors playing it, and that nickel was the one that they were like, no, that's the last nickel, and so just millions of people in the streets. And so I think if you kind of get into that, more kind of banning of something that it's literally kind of code, it's literally math, you're basically, people have argued that you're essentially banning speech then,
Free speech, yeah.
if you're banning this kind of digital asset. And if anything, so there's all sorts of issues, like, so people have pointed out the privacy issue, how it used to be, early days it was used for like legal stuff more often, but it's actually funny because it's actually rather trackable. It's literally like, if you were a criminal, you should use cash, not
Yeah,
Bitcoin.
yeah.
It's literally
Totally.
worse.
Yeah.
And so, for example, a lot of those kind of early arguments, I think, are slowly fading away. And as it gets more and more institutionalized, it gets harder and harder to ever ban. Now, I do think that taxing it to death is probably a higher risk. So, for example, in the United States, gold is taxed as a collectible, which means it has a higher tax rate than long-term capital gains. And so that's kind of a subtle way of sort of
Huh. I
punishing.
didn't know that in the US. Okay. It's
Yes.
it's a commodity here.
Yeah, so we tax it more like a collectible, and so it's just kind of all these frictions around the edges, make things like that harder. And so I do think that Bitcoin will have some political pressure in different countries, and I do think that could certainly affect its price over a given year, a given 2 years. But then you get into an international game theory. So if one country bans it, another country can say, well, we're not going to ban it. We're actually going to subsidize miners, and we want your exchanges to host here. And then you kind of have this game theory where then whatever country bans it is now kind of risking falling behind on the digital ecosystem, right? So there's not just Bitcoin, there's technologies like stablecoin, there's tokenization of financial assets. all these kind of things that can reduce frictions for payments or kind of make ownership more divisible of financial assets and things like that. So I do think that they risk falling behind on that if they try to take some of that more hardcore stance against it. So you get that kind of game theory in play. And as far as central bank digital currencies, you know, the, when they introduce that, like say you ever backed a currency by gold at this point, it wouldn't be backed at anywhere near the level that gold is now. So that would be part roughly of a currency devaluation, right? So if you were to ever reback it, you wouldn't say, okay, gold right now is, call it 2000 and we're going to back at, gold at current price. It's more like you'd have
Got it. Gold.
yeah, you'd have a devaluation, and then to stabilize it from at that low level, you'd have a repeg to gold potentially. And so that's kind of part of how they inflate away debts, is to kind of reduce that currency relative to something like gold. I mean, that's what we saw, for example, in the 1930s as well. Even before they had that inflationary decade of the 40s, they had a reduction of the gold peg in the 30s. And so you'll never see kind of uh, you know modern currencies pegged roughly where they are against gold. You see a devaluation first. And so it's
Got
something
it.
to consider.
Okay, what about, do you think another financial system can be built out here? Like, are we going to see a yield curve in this world? Is because the more I look at it, I'm like, is there a second financial system just being built out? And the players that be are saying, okay, we're going to milk this financial system for what it is. But on the side here, there's all this stuff being built out that to me, and I know this is a longer play. This is, now we're talking 10 years, maybe 15 years, something like that. But it seems to me that there's a second financial system being built out on a totally different foundation. Do you see that at all?
Oh, that's definitely what we're seeing. I mean, we'll see how far it goes, but in terms of what's happening now, that is what's happening. So, for example, we have now a lending market around Bitcoin and some other cryptocurrencies where, you can basically borrow in Bitcoin, or you can use your Bitcoin as collateral to borrow, fiat currency, for example. And so that's, for companies that have their expenses denominated in cryptocurrency, uh, to be able to use their cryptocurrency to get liquidity is helpful. So we are starting to see kind of that credit market develop. We're also starting to see, stable coins, which is, you take a fiat currency and you wrap it in kind of like a cryptocurrency wrapper. And that kind of increases the liquidity within the crypto native system. So it kind of goes around exchanges or financial institutions more readily in that kind of decentralized system. And it even kind of makes international payments potentially more easier. And then it provokes all sorts of capital flight kind of concerns that regulators have, and then you start kind of pushing up against the rails and causing issues. So I do think we are starting to see this emergent kind of second financial system. Now we have banks that are specifically kind of lenders to some of those companies. I mean, I'm familiar with some of the big investors in the space. So investors that fund some of these companies that are involved in either lending or custodying or things like that. So I do think we're certainly seeing this kind of other system develop. And the big question is how far it goes. I mean, does it get kind of kind of crippled by regulatory action? Does it kind of develop slower than people think? And of course, you always have these kind of fake breakouts. So if you, back during the previous Bitcoin bull run in 2017, you had this big kind of ICO phenomenon, which is initial coin offering, and a lot of that was scammy. And the SEC started to get more involved, and so you kind of have these kind of false breakouts where you have this kind of scammy behavior, and then the dust settles, and then you have kind of kind of a slower, more real economy develop along the way. So for example, like the credit markets revolving around cryptocurrency, that's been a more kind of a long-term steady increase rather than kind of a fad.
And are you advise a lot of different people, different backgrounds, different types of companies. Are you seeing any more interest recently or curiosity in this kind of space, aside from the person like me and my brother who are just like, holy crap, this might be more like hard money in a store of value than we ever thought possible? We're in. Are you seeing? And I guess I know the answer. When Fidelity comes out and says, yeah, we're playing in this game, you must be. But can you tell us anything of what you're hearing without naming names, or just some interesting observations that you're making from the space?
Sure. I mean, there's a couple things. So I wrote my public Bitcoin article in July. That was kind of my big public piece. And for example, the CEO of MicroStrategy, the first company to put part of their treasuries into Bitcoin, he cited that article, and he also cited some of the other kind of
How cool is that?
It was
How
really
cool
cool to
was
see.
that?
Yeah, it
Was
was
really,
awesome.
yeah, 450 million or whatever, 25, whatever the number is. I've lost track. Like for
Yeah.
someone to be citing your article with that kind of move.
Yeah, so there's definitely kind of like you're basically reaching institutional grade investors at that point. And then, I had a conversation with a small bank board of directors, for example, and they were aware of the Michael Saylor kind of decision to put, that money into Bitcoin, and were aware that he referenced that article. So they were kind of like, okay, as a bank, what are we missing about Bitcoin? Do you consider it a real asset class? And so they asked questions about it. And so, for example, I was there to talk to that bank about, kind of some of the stuff we talked about earlier, which is fiscal monetary policy and how it potentially can impact a banking institution. So I didn't even have slides on Bitcoin. I didn't think to talk about Bitcoin to them. And so the first question when I was done is like, so what about Bitcoin? And so there is definitely institutional interest. We had, if you look at the news over the past 48 hours or so, we saw kind of the head of BlackRock fixed income. He came out really bullish on Bitcoin uh, on CNBC. And then we
I
had,
missed that. I didn't know that. Okay, got it.
yeah, it just came out like probably 24 hours ago, and then we had another guy on Bloomberg talking, kind of I think he
I
works
saw
at,
that one. Yeah,
yeah,
yeah.
and so we're
I
starting
like
to,
the commentators' faces when they're looking
yeah,
at him. They're like, they don't. It's like, really, like, what are you talking about? They're not
yeah,
cluing in at all at this point. Yeah, yeah.
yeah. So you're starting to see this kind of breakout in institutional interest. So whether it's Fidelity, they started earlier. Fidelity, they started last cycle, but it's starting to kind of hit momentum now. But when you see Stanley Druckenmiller talk about it, when you see, uh, you know, uh, BlackRock talk about it, I think a lot of people, it's on their radar now. Now, I do think, as we're kind of poking near previous all-time highs, I wouldn't be surprised to see, as we go up, we get this kind of parabolic interest in it. And probably, I wouldn't be surprised to see a correction, a consolidation, and then people say, "Oh, see, it was another bubble." So I do think, I wouldn't be surprised to see some rocky price movements over the next 3 to 6 months, just because when you start to see so many people talk about it at the same time, you have to kind of get a little bit cautious there. But one thing I've shown, for example, and I've seen others share this, is that if you look at Google search activity for Bitcoin, it absolutely skyrocketed back in 2017, of course, when you had that kind of big run up. So search activity skyrocketed. Now, in the year since then, Bitcoin search activity has been pretty low, even though the price has creeped up back near all-time highs. So there's really not that kind of wide retail kind of fear missing out and like hyper interest yet. It's just kind of still in the early phases for this particular cycle. Like you don't have kind of wide, kind of bullishness on it. We are starting to see kind of excitement in some of these financial media, and so I do think it's good to be a little bit cautious about kind of
Yeah.
maybe the near term.
Yeah, I'm personally getting multiple text messages a day. Tom, tell me about this Bitcoin thing again. How
Yeah,
do I get it? Where do I buy it? So yeah.
yeah.
Um, Lyn, how did you get into this particular role that you're doing? Just as we wrap here, you're really good at what you do. So, your blog posts are excellent. Anyone listening to this, you got to check out your website. We'll give out the URL. I know you have a membership that you kind of run. And so how did you get into this? Because I think someone on our team was looking into your background and I guess they were spying on you, Lyn. There you go. Someone was spying on you behind your back today. And I thought they said you were an engineer. How'd you get into this? The way you break out your thinking is really clear. Like it's really well done.
Yeah, I'm an engineer by training, and so before I was an engineer, like 15 years ago, I was an investor first. But then when it time to go through university, I went into engineering instead of finance. So then I worked in engineering, and then I eventually got a master's in engineering management. So I kind of married that with finance. So it was kind of engineering economics and running the finances of an engineering facility. So I kind of brought those two interests together. But on the side, I've always just been really interested in finance. It's kind of my first passion. And so, when I made the research firm, it's kind of like taking an engineering mindset and going and studying things from first principles that maybe, other is not really kind of being studied in other institutions. And just saying like, and just kind of doing a lot of data mining and research and kind of, putting pieces together and kind of approaching it like an engineering problem. And I think that way of writing, that way of kind of expressing it is kind of stood out and kind of differentiated a little bit.
Yeah,
Uh,
you have one article here. I don't know if this is one of your free articles or not. It's banks, QE, and money printing. You updated it on November 8th. I
yeah,
printed it out. I thought it was going to be like 10 pages. So I was reading. I'm like, this is really good. I want to print this thing out. You can't probably see this on the screen, but I printed it out. I'm like, This thing is like, I don't know how many pages I just printed out. Like just this report. Is this one of your free ones or is this a membership one?
Yeah, that's a free one. I think
That's
I think that's like 60 pages. Yeah.
Yeah, 60. So anyone listening to this, because we have a lot of people listening to this say, hey, Tom, Nick, I want to learn about, macroeconomics as well and kind of get into all this stuff. Lyn's article here, if you find this one, you did such a great job. Like it's called Banks, QE, and Money Printing. It's updated November 8th, 2020. Just print this thing out and read this thing. You're going to know more than 99% of anyone, I have a feeling. Like it's just amazing stuff. And I know it could sound like I'm pumping your tires up here. And if that's what it sounds like, I mean it. It's really good. So thank you for sharing everything that you're sharing. So the URL for Lyn is so Lyn Alden's investment strategy website. It's lynalden.com. In the show notes of this, so if you go to rockstarinnercircle.com/podcast and you find Lyn Alden's show notes, we'll have it linked out there, but it's Lyn Alden, LYNALDEN.com. You have a free newsletter that you can sign up for there. I would highly recommend that newsletter. And you're on Twitter. And you're getting popular when I think your Twitter handle was all hijacked the other day and people were making fake accounts about you and that whole thing.
I've gotten 3 of the copycats banned, and then two of them just sprung up. So it's at least.
Oh,
5
really? Yeah. It's like whack-a-mole. You're just smashing them down. So it's at Lyn. So the correct one is at Lyn Alden Contact.
Yes.
Correct.
Yes.
At Lyn Alden Contact. Anything else you want to share about just what you do and what you offer?
No, that's it. I mean, most of my work is free. I do public articles. I do free newsletter. Then I also have a low-cost premium service for people that want to get more frequent updates that are more timely, or that want kind of individual stock analysis. So depending on what they're after, most people just follow the free material because it's kind of big picture and applies kind of regardless of what asset class you're in or kind of what country you're in. It's kind of big picture stuff.
Cool. Lyn, thank you so much for doing this. I know you're busy. Totally appreciate it. This was of huge value. So thank you so much, and great to get to know you better. Thank you.
Yeah, thanks for having me. And I think you're doing a great job with the, kind of educating people, bringing all sorts of different voices. And I think that's really valuable. Thanks
for that. Thank you. Appreciate it, Lyn. Thanks. Hey, everyone. So hopefully you enjoyed that chat with Lyn. You can get more of Lyn on Twitter. Her handle on Twitter is at Lyn Alden Contact. That's at LYN Alden, ALDEN Contact. So at Lyn Alden Contact. She has a bunch of pirate accounts kind of popping up, trying to copy her account and stuff, but that's the official one, at Lyn Alden Contact. If you reach out to her, make sure you say hi. You can check out her not real estate investing newsletter. What am I talking about? Her macroeconomic newsletter and analysis that goes along with that on her website. You can subscribe for that. Wow, I'm really struggling with this, but we're going to get through it. At lynalden.com. That's www.lynalden.com. That's it for now. Until next time, everyone, your life, your terms.